Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon, and as ever I'm joined by Robin Bew. Robin, you've revised your US GDP forecast upwards for next year, but then downwards again for 2011. So are we looking at a W-shaped recession?
Yeah, I think we are. I mean, if you look at what's going on at the moment, we're on the upward slope. Things are clearly improving. There's a lot of green shoots around, not just in America, but elsewhere. And that does represent a genuine improvement. We do see a bit more activity. And so while clearly there's still a lot of hardship around and some businesses are still doing very badly, we do see a bit more demand. But there is a couple of things driving that. One is this turnaround in the inventory cycle. But perhaps the most important thing is what's happening with policy, because the policy stimulus measures that we're seeing put in place in a whole lot of markets, but America is clearly an important one, are feeding through into a slightly better economic picture. But for us, the question is how long can that be sustained? At the moment, much of the policy stimulus is scheduled to be removed or at least watered down a bit when we get to the end of this year or into 2010. And at that point, we'd expect to see growth drop back. So that gets you the second leg down of the W-shaped recession. Now, what happens after that is whether there's a sustained private sector recovery or whether the government actually has to step back up to the plate and inject yet more stimulus in. Now, if you look to Japan in the 1990s, you saw not a W, but a series of Ws, one after the other, because the government would inject funds, then they'd stop and the economy would drop back into recession. There's a bit of a risk of that, but certainly I think we need to expect this upward swing that we're seeing at the moment to be followed by something a bit more negative during 2010.
So there could be an outside chance of a further stimulus package to the US economy, but we're likely to see surely some political opposition in Congress.
Yeah, I mean, right now, do you still see a significant number of people in Congress worrying about the US long-run fiscal position? I mean, with some good reason. I mean, clearly the fiscal deficit in the US is going to be 15% of GDP this year and next year, and that does raise difficult questions about affordability of stepping up to the plate and doing anything else. At the same time, of course, if the economy really started to tank as stimulus was removed, the political imperative would start to change again. And I think, if you look to Japan and what's happened to their public sector debt, you can see that when the economic situation is bad enough, governments are prepared to run substantial deficits over a very long period. So we certainly can't rule it out. But given the size of the deficit we see in the States at the moment, and as you say, the congressional opposition to a second package, I think it's pretty likely that the stimulus will be withdrawn and everyone's going to wait and see what happens. And our view is that the economy will slow because we don't see the strength in the private sector yet.
In terms then of economic performance over the next couple of years, you're saying it's going to go up and then it's going to go down. So how's that going to impact rates policy in the main economies?
Well, I think when you look at what central banks are saying, and so you look at the Bank of England or the Fed, for example, particularly, they are pretty clear that they're not interpreting the current uptick as suggesting that there's a sustainable private sector recovery in place. They all seem to be saying pretty clearly that this is policy-driven and that the economy is not robust enough yet for them to withdraw the stimulus, which is interest rates, but also actually, of course, the quantitative easing, the printing money that we see. So it seems that they are not going to make the mistake that we saw in Japan, which is when the Bank of Japan did mistake the policy stimulus for a sustained economic recovery and started to try and raise interest rates, and clearly that policy turned out not to be the right one. Well, it looks like we're going to avoid that. So I think our view is interest rates will remain low for a very long period of time, both in Europe and in the US, and that the uptick that we see now, policymakers don't seem to be mistaking that for a sustained private sector recovery.
If the private sector recovery then is a long way off, what shape is public sector involvement in economies likely to take? I mean, we've got a government in the UK very keen to flog off its recently acquired bank assets, but do you think that the public sector might actually have to intervene more in economies around the world?
I think it's going to be very difficult, I would say almost impossible, for the government to sell back off the institutions that it's bought. And indeed, I think you're right that they will have to get more involved. In fact, what we're seeing at the moment is that a lot of the woes in the private sector are gradually being transferred into the public sector. I mean, you only have to look at the press stories. 6 months ago, 9 months ago, many of the news stories were around what was going on in terms of the corporate position and businesses getting very weak. Now all the headlines are around government fiscal position and what's happening to public finances. And that's a reflection of the fact that the government is much more involved in the economy than it was before. And because the private sector is weak, it's carrying all this debt, actually going forwards, we're going to see the government remain very, very engaged and probably even more engaged than it is at the moment. So the idea that we're going to see government gradually withdrawing, so the share of the role of the state in society kind of shrinking backwards. That can't happen until the economy recovers, and unfortunately we're not always seeing that. So I think we have to get used to a world in which the government is much more engaged across the board.
In this global forecast, you clearly feel that China can maintain and even improve current levels of growth.
Yeah, we're pushing our forecast up to just under 8% from just under 7% from before, and really that is a direct reflection of the fact that their fiscal stimulus package has been astonishingly effective. I mean, of all the countries around the world that we look at, the Chinese government, perhaps unsurprisingly, has been the one where the lever that it pulls seems to be most closely connected to the real economy, that you have seen them inject a lot of cash through forcing much higher loan growth, for example, and that's fed through and the economy has improved. They want 8% growth and it looks like they're going to get it. Unlike many other economies around the world, such as the UK or the US, they can afford to keep this up for a very long time. So we have fewer worries about them running into significant funding constraints, although even so we do actually expect growth in China next year to be no better than the growth that we're seeing this year, because I think the government is going to be very reluctant to ramp up even further. They are very worried about a bad loan situation starting to build because they're pumping all this credit out into the country. But certainly their fiscal stimulus has been extraordinarily effective, and that does mean that growth will be better than perhaps once we feared it would be.
Now, we have another factor that we obviously have to throw into the mix, namely swine flu. Do you think the likely economic impact of this has been overstated or understated?
Well, generally, when you look at these issues, I mean, you go back to SARS, for example, what you tend to see is that when they hit, they can have a very negative effect, but it tends to be relatively time limited. So if you look to Asia in the SARS crisis, we did see a pretty significant shakeout in economic growth, but it was relatively confined in terms of how long it affected. This is rather different. It seems to be much easier to catch, but much less dangerous when you do catch it. It's kind of hard to work out whether that makes it better or worse. It may make it worse because, of course, it means that quarantine measures and things like that will probably need to be a bit more intrusive than they were under SARS. I guess to us, the worry is that normally when you see something like this happening, governments try to offset it by doing something with policy. And the difficulty right now is in most countries around the world, they don't really have any ammunition left. So if swine flu does drive a deteriorating economy, normally you'd expect to see government step up to the plate, but right now there's probably not much they can do, and that's a bit of a concern. But I think it's important not to overstate the impact of this on economic growth. Sure, it is important, and it probably will have a negative effect on demand if we do see a pandemic arising of the scale that perhaps people are now talking about as winter breaks in the Northern Hemisphere. But these things tend not to drag on for a very long time in terms of the economic impact, but we are worried about the inability of policymakers to respond.
What about regulation of the financial services sector? Do you really think there's the political will to toughen up regulation?
Well, I guess the policy measures which are currently being discussed in most markets perhaps are not quite as stringent as you might have expected given the debate that was going on 6 or 9 months ago. So we are seeing some sensible things being discussed, particularly around higher capital requirements, particularly for banks that are engaged in risky activities. But some of the really draconian things that did seem possible 6 months ago, intervening to break up large institutions, that kind of thing, that sort of seems to be off the cards. I guess the thing that's been very interesting most recently is this debate about pay, particularly driven by what's been going on in terms of Goldman Sachs. And I think there's an interesting issue there around the politics of all this, because it does seem pretty clear that this is an issue which certainly has some political resonance. It's been written about a lot in the media, and that could prompt perhaps a bit of a clampdown in terms of what they can do to try and perhaps require higher capital requirements for banks that are giving out what they view as excessive pay increases. But I would say that the regulatory regimes that seem to be being talked about, while sensible, are not perhaps as draconian as perhaps you would have assumed given the severity of the crisis.
So in summary, do you think that reports of the death of free market capitalism have proved to be a little premature?
Yeah, I think that's been pretty premature. It seems to us that the money of the kind of forms and functions of the Western economy that we know and love look like they're largely going to remain in place.
Thank you, Robin. So capitalism lives to fight another day. To get more global prospects, join us again next month. Until then, thank you and goodbye.